Imagine turning $1 into $100, or even $1,000 over time without lifting a finger. Sounds like magic, right? Well, Warren Buffett, one of the wealthiest people on the planet, says it's not magic but math. Specifically, the power of compound interest. Picture a snowball rolling down a hill. It starts small but gathers more and more snow, getting bigger as it goes. That's compound interest for you. Today, we're going to break down how this incredible financial principle made Warren Buffett super rich and how you can use it to grow your own wealth. What is compound interest? Compound interest is the financial magic that makes your money grow faster over time. Instead of earning interest only on your initial investment, you earn interest on both the principal and the interest you've already gained. It's like a snowball effect. Your money keeps building upon itself, accelerating your wealth. Warren Buffett's early years, Warren Buffett, often called the Oracle of Omaha, had a knack for understanding the value of money from a young age. Born in 1930 in Omaha, Nebraska, he bought his first stock at just 11 years old. Imagine being a preteen and investing in a business. But that's precisely what young Warren did. He invested in a company called Cities Service, buying 3 shares at $38 each. Though the stock price initially dropped, he held on. Eventually, the stock rebounded, selling at $40 per share. This early experience taught him 2 crucial lessons that would define his investing philosophy: the importance of patience and the value of long-term thinking. While most kids his age were saving up for a new bike or toy, Buffett was learning about the stock market and setting the stage for what would become an extraordinary investing career. These foundational principles, combined with his understanding of compound interest, would later turn him into one of the wealthiest individuals in the world. Long-term thinking. Long-term thinking is the cornerstone of successful investing, a principle Warren Buffett has championed throughout his career. Instead of chasing quick profits, Buffett focuses on the intrinsic value of a company and its potential for growth over years or even decades. This strategy allows him to benefit maximally from the power of compound interest, as money grows exponentially over time when reinvested. For example, one of Buffett's most notable investments was in Coca-Cola. In 1988, he began buying shares of the company, eventually accumulating a 7% stake. At that time, Coca-Cola was already a well-established brand, but Buffett saw its long-term growth potential. Fast forward to today, and the dividends from that investment alone are massive. He didn't jump in and out of the stock. He held on to it because he believed in the company's enduring value. This approach of buy and hold allows investors to not just earn, but also compound their earnings over time, significantly magnifying their returns. That's the real power of long-term thinking. Case studies. Warren Buffett's investment portfolio offers several compelling case studies that illustrate the power of compound interest and long-term thinking. Coca-Cola. Buffett's investment in Coca-Cola in 1988 is an iconic example. His initial investment of approximately $1 billion has grown manifold due to the company's consistent performance and dividend payouts. Today, those shares are worth several times the original investment, thanks to the compounding effect of reinvested dividends. Berkshire Hathaway. Perhaps the epitome of compounding success is Buffett's own company, Berkshire Hathaway. He took control of it in the mid-1960 OS, when it was a struggling textile mill. Through wise investments in various industries, the company's book value has grown at a compounded annual rate of about 19% from 1965 to 2020, significantly outpacing the S&P 500. Apple. Buffett surprised many by investing in Apple in 2016, a tech company which seemed at odds with his traditional investment style. However, the decision was grounded in the same principle: long-term value. This investment, too, has compounded incredibly well, adding billions to Berkshire Hathaway's value. These case studies show how Buffett's focus on solid long-term investments allows for remarkable financial growth through the magic of compound interest. Common mistakes to avoid. When it comes to benefiting from compound interest and long-term investing, several common mistakes can throw you off course. Impatience. Many people want quick returns and thus jump from one investment to another. Frequent trading not only incurs fees but also interrupts the compounding process. For instance, if you invest $1,000 at a 7% annual rate, it could grow to nearly $2,000 in 10 years. But if you keep switching investments, you might miss out on this growth. Not reinvesting dividends. The true power of compound interest comes from reinvesting earnings, including dividends. If you spend the dividends instead, you're only getting simple interest on your principal. High fees. Investing in funds with high management fees can eat into your profits, reducing the compounding effect. For example, a 1% fee might not sound like much, but over 30 years, it could reduce your investment returns by nearly 30%. Poorly timed withdrawals. Removing funds from your investment at inopportune times can seriously deplete your earnings. For instance, if you withdraw during a market downturn, you might have to sell off more shares to get the amount you need, reducing the base for future compounding. By avoiding these pitfalls, you can make the most of compound interest and set yourself on a path toward long-term financial growth. Benefits of compound interest. The benefits of compound interest are transformative, turning even small sums of money into significant amounts over time. Here's why it's so powerful. Accelerated growth. Unlike simple interest, which only grows linearly, compound interest grows exponentially. Your earnings generate more earnings, forming a cycle that speeds up as time goes on. Long-term benefits. The longer you let your money grow, the more exponential the increase. A decade or more can make a substantial difference. Financial security. Compound interest can offer a solid foundation for retirement or other long-term financial goals, turning modest, consistent contributions into a sizable nest egg. Example, let's say you start with $1,000 and contribute an additional $100 every month into an account with a 6% annual interest rate, compounded monthly. In 20 years, you'd have around $50,000 if it was simple interest, but with compound interest, you'd have about $60,000. Low effort. Once set up, a compound interest account requires little to no ongoing effort. It's a set and forget strategy that works while you sleep. Flexibility. You can start small and still end up with substantial gains. Even if you can't contribute regularly, the initial amount continues to grow. Compound interest is a compelling way to build wealth, offering exponential growth with minimal effort over the long term. And there you have it. The incredible power of compound interest isn't just for financial wizards like Warren Buffett. It's a tool that each one of us can use to make our money work harder for us. Whether you're saving for retirement, a big trip, or just want to grow your wealth, understanding and applying the principles of compound interest can be a game changer. So why not take that first step today? Open that savings account, make that investment, and let your money snowball over time. If you found this video useful, please hit that like button. It helps us know what content is making an impact. Don't forget to subscribe for more informative videos that can help you take control of your financial future. Sharing is caring, so if you think this video could benefit someone you know, go ahead and share it with them. Thank you for watching, and here's to your journey towards financial freedom through the magic of compound interest.